Hi.
Yeah, of course, I.
Yeah, so I guess let's start. Last time we talked about option trading and what futures and options are. But what I realized after that was the fact that we should actually think of something that's even much more fundamental than trading, like how to actually manage your finances and how one can go through their, maybe let's say for me, their 20s and make good decisions regarding finance. So having said that, I wanted to ask you, can you look at my portfolio and just tell me what you think about it? So my portfolio has mutual funds, it has stocks, and it has crypto. So I'll just share my screen. I'll show you my portfolio. Just have a look. I'll take you through it very quickly, and let me just share my screen first.
Mm.
Okay. Let me know once you can see my screen and
Yeah, I can see your screen.
so this is my stock portfolio, if I were to say. And
Hmm.
basically, the most of these are long-term investments. Like I've had most of these for more than 3 years now. Actually, most of these on an
Hmm.
average are more than 1.5 years, some of them being more than three now. And I have mostly invested in small cap and mid cap stuff. Just
Hmm.
have a look, and if you have any questions, I'll answer, and I'll take you through my decision making if there's any.
Yeah, I mean, so I'm just trying to understand. So it is saying that your overall net change is 71.4%. Is that correct?
Yeah, this is over 3 years.
No, so now, and you have invested 90,000. Is that correct? Or how much have you invested exactly?
Yeah. Somewhere around that. I had invested around 1.5. Like I think 1 week ago
Hmm.
only I sold some because I didn't. I had basically Bajaj Finserv, which I bought back in
Hmm.
21, which was for like 15K.
Okay.
I felt like that wasn't going anywhere, and I thought, okay, maybe that's time to take that money out and put it in a mutual fund. So I'm yet to do
Hmm.
that, but this is basically my stock portfolio, wherein
Hmm.
I also have gold bonds, if you can see over here.
Hmm. Yeah.
Uh,
Yeah.
are you able to see my mouse?
Yeah, I can see. I can see the cursor.
Okay, great. So I bought these around 2.5 years as well. I think I bought these in October. And apart
Hmm.
from that, so I haven't done any SIPs until now, which is something that I'm gonna start doing. But this is what my
Hmm.
mutual fund portfolio looks like. Again, these are all one-time investments about 2.5, 3 years ago.
Hmm.
This was basically back when COVID had started and maybe the second wave was going on around 2021. This is
Hmm.
mainly that part. And then these are my crypto investments. Highly risky, and as you can see, everything is completely red. But this is also something that I invested thinking over a long period of time, not something that I want to touch before 2030. Um,
Hmm.
so this is basically what my
The amount
investments
that you
look
have
like.
invested,
Sorry.
the amount that you have invested in crypto.
This would be around 70K.
All right, all right. Almost nearly as much as stocks. Stocks was close to say 1 lakh approx. If you hadn't removed Bajaj.
Yeah. So one thing that I would like to share here is the first entry that you see here called Thor Chain.
Hmm.
This was
Hmm.
supposed to be a short-term investment. But
Hmm.
what happened was I got greedy and I was like, okay, it will go up. And then I
Hmm.
forgot about it and it kind of went down. And I'm
Hmm.
just waiting for the price to come in. Like I don't really mind keeping it, but I also don't mind selling it at let's say 2% profits because 1% will the government take as TDS now. So I don't I this is I'm just waiting for the price to come in, and I feel it might come in the next 2 to 3 months. So I want to sell this first thing off as soon as possible and shift this money to
Hmm.
either mutual funds or stock. Apart from that,
Okay.
this is my Ethereum. This I am basically planning to put it into a. So basically, in crypto, there are certain places where you can stake your money in, and they'll give you interest to simplify things.
Okay.
So this is
Hmm.
something that I'm planning to do with that. And apart from that, yeah. So this is what I have right now.
Yeah.
I I, I
And
I guess you want to
are
start
you
with stocks.
no no and do you also have like a PPF going on for you?
I do have a PPF, but I just made that because I wanted to have one. I haven't invested any. I've just invested 500 bucks in it right now. That was because I opened it last year and I invested the
Hmm.
minimum amount, and I plan to invest around the same right now in for this year as well. But I do have a
Hmm.
PPF account.
All right. All right. And your total investments are close to, and why do you have liquid funds in your mutual funds? Is it just because you've temporarily parked capital, or is it a part of a strategy?
Oh yeah, so this is something that I do. So I basically temporarily put money in over here. Since
Hmm.
there is, so for me, the basic thinking was if money is in my bank account, I will see it being it there. So what I do is some amount that I know I don't need, or maybe when once my salary comes in, I'll place all the money in over here,
Hmm.
and only take out the funds that I know I'm gonna need. So I also have my insurance and health insurance and life insurance. So what I do is any
Hmm.
amount. So I have quarterly payments for it. But what I do is I save money every 1 month, put it in
Hmm.
this Access Overnight Fund, and I just let
Hmm.
it be there. I only take it out once I need it. For example, if I need to make my insurance payment, or let's say I've had some unexpected expenses, and that's when I take money out from here. But I keep on adding money here. As and when I
Hmm.
need it, I take it out, or else I let it be here.
Because I'm just, in principle, it looks like, okay, say you have a contingent liability, like 3 months later, you're required to, let's say, make a
Hmm.
premium payment of 5,000 rupees.
Hmm.
You seem to have made a plan for it by simply sending it to your liquid fund portfolio.
Yeah.
And then as in when you need to withdraw the 5,000 rupees, for example, you will just sell off these units, they will credit back to your account and you will make the payment. Is that how you're operating?
Yeah, that's the plan. In the sense, if I have money that time, I won't really take it out. But if I
Take out
don't,
from
I
here.
will. Yeah.
Okay, okay.
So that's the
Uh,
plan. Until now, to be honest, it has been that I didn't have the money and I had to take it out. But
hmm.
that is ideally what I want to do.
Okay, okay, okay. So have you considered like just speaking to the bank in which you have your saving account to maybe make it like, have this auto sweep facility by any chance?
I do not know what that means.
Okay, so auto sweep basically it's just a term. Even I'm not like a banking expert, but when you say that they understand it quite well, the term is auto sweep, wherein you decide a certain amount of your, let's say, for example, you feel you need 50,000 rupees liquid cash at any point in time in your account, for example, and
Hmm.
you already, and let's just say your salary gets credited tomorrow and
Hmm.
an additional 50,000 or 1 lakh gets added to your account on a because the salaries got credited. Now, if
Hmm.
you have set the auto sweep at 50,000 rupees, the bank will leave the 50,000 rupees in your saving account and send the remaining money automatically to a flexi FD account, wherein if the money is kept there for 3 months or more, it attracts FD rates. And currently, even the most conservative FD rates are approximately 0.5 to 0.65% per month. And obviously, it's not at any cost. There is no expense associated with
Hmm.
it. It's
Hmm.
a
Hmm.
service bank offers you. And what I have realized is that, whether be it liquid Bs or be it liquid funds, the
Hmm.
current interest rates in the FD market are so high that they typically tend to outperform these instruments very, very comfortably. So you could like, I mean, if I'm just seeing, so you have a very small amount, obviously, in the ICICI liquid fund. It's just 500 bucks,
So
but your ICICI.
that was basically I was comparing both ICICI and Axis when I was buying
Hmm,
these. So ICICI
hmm,
had a higher expense ratio. So what I thought is,
Hmm.
okay, 500 bucks, I'll put in both of them,
Hmm.
just to see, okay, how they perform over a span of 1 month. And I realized, okay, Axis was performing better. So I never
Hmm.
took out money from my ICICI fund, but I just kept adding more in my Axis fund.
Okay. Yeah. Yeah.
So
Yeah.
it doesn't really make a
So
difference for me if it was there or here. I just never took money out because if it's there, I let it be there. Like there's no point in me taking out. I don't need the money.
correct. Correct. Great. No, you have a really good, not just equity portfolio. You have uh, you have a predisposition towards trying out many instruments, and that's a huge step in acquiring familiarity. Like you buy unit tokens on multiple places, and it's it's only where you put your 5,000 or 10,000 is that's the place where you eventually put your 1 crore, 5 crore,
Hmm.
right? Like for example, if you see a person who's say today traveling in a 5 crore rupee car, that's usually not his first car or her first car. They could have started at any level relative to their background. Some people start from scratch, some people have inherited some things. But typically, if they're buying something sizable, like which is a significant representation of their personality or their net portfolio worth, it's not their first purchase when they're doing that. And
Hmm.
it starts off like this. So the trend is very positive. Like it starts off like this only, where you're venturing out into various products and services. You gain an experience and you form an opinion based on that experience, and that is where more and more money over a period of time starts getting allocated. And I just have a question, like what is your view on or have you explored like the national pension scheme?
I have not. I have not. Actually, I've heard about it, but I've never really thought of it.
Okay. And fair enough. So, before I try to answer something specific to your portfolio, I'll just tell you, like let's just say if I were your age, say 2025, and if I knew what I knew today, so
Hmm.
I think I already knew back then, but because I had inherited that learning from my parents,
Hmm.
that's how my father would typically function to a large extent, and I inherited it, and I have seen a couple of cycles of it getting mature. So, I can vouch from personal experience, so to speak. Um, so let's just say you are making an annual saving of 5 lakh.
Hmm.
All right. That's a huge amount, by the way, for your age, because to make an annual saving of 5 lakh, you need to save roughly 40,000, 45,000 rupees a month.
Yes.
That is a saving,
Hmm.
which means you obviously need to earn more than that,
Hmm.
right? Then your earning minus your expenses, which will equal to your saving, that saving has to come to close to 50,000 rupees a month, 45,000 rupees a month for an individual to save 5 lakhs a year, which is greater than a huge percentage of this country at the
Hmm.
moment. Yeah. So what I typically do is I just look at the first thing that I see is I personally see which is the maximum interest that I can attract on zero risk, right? Like that is there is no risk, and what is the highest interest paying component in the world for me in my investment universe, right? And so for the individual like myself, I find that in PPF.
Okay.
All right. A PPF is that instrument which will give me the maximum possible interest rate, and there is absolutely no risk of default.
Hmm.
And a PPF is also immune from bankruptcy. It's immune from any legal cases. So, say for example, if tomorrow you were to set up a business and it were to get into losses, they cannot take your PPF to recover it, but they can square off all of this to recover it.
Oh,
You
okay.
understanding? Yeah. So, for example, if you set up a small shop or something, and you engage into an activity in which they find you personally liable
Hmm.
beyond the scope of that shop, and they want you to make a payment. Now, the courts have instructed you need to make the payment,
Hmm.
and you raise your hand saying, "I don't have that much cash." The courts can simply square off everything you own
Oh,
in order
okay.
to make the payment, but they cannot do it for PPF. Similarly, individuals who get married Their marriages tend, if it tends to fail, there is certain alimony that someone might have to pay. The
Hmm.
courts cannot touch it if it's
All right.
immune from any kind of threat. The government cannot default on it. So now, my point being that PPF is the safest of safe instruments.
Hmm.
Alongside it is triple E, which means it is exempt. The principal is exempt. Means there are certain definitions for it, but you
Yeah,
actually
yeah, yeah.
attract no tax.
Yeah,
And
that I'm aware.
yeah, and yeah, and I mean 1.5 lakh rupees is the baseline for it.
Hmm.
Okay. So now when I know that the best risk-free zero default instrument for me is a PPF, and the maximum possible capital that I can allocate to it is 1.5 lakh rupees in a year,
Hmm.
that becomes my one unit. That means I consider 1.5 lakh rupees as one unit. Reasonable?
Hmm.
Yeah.
Okay.
Because the government has decided it is 1.5 lakh is the upper limit. Tomorrow
Hmm.
the government could 2.5 lakh, or maybe
Hmm.
the government could reduce it to 1 lakh. But whenever the government changes it, I will change my definition of one unit.
Hmm.
Is that logical?
Yeah, that makes sense.
Yeah. So let's say 1.5 lakh is one unit. And we are saying that because the risk-free interest rate market is attracting that as the maximum possible value,
Hmm.
right? Uh, so now 1.5 lakh rupees becomes my one unit. And what happens if you put that 1.5 lakh rupees, let's say in the month of April itself, in the PPF? That money has gone into the debt market, so to speak, because it
Hmm.
is attracting interest, right?
Hmm.
And with that, you would have made an investment in a debt instrument.
Hmm.
So when does a debt instrument benefit? And that also something which has a 15-year, 20-year, etc. maturity. You can increase it in blocks later, but by and large, it's a long-term risk-free debt instrument, right? And the one unit that we are investing is worth 1.5 lakh rupee. So when does a debt portfolio give us maximum bang for our money? And the answer is in the event your currency appreciates.
Huh.
Is that
Okay.
making sense?
Yeah.
All right. For example, if you asked a child in 1950s or 60s, what is the value of the rupee to a dollar, he would have given you an answer 3 or 4 rupees, right? If you ask them in the 70s, he would have given an answer of 6 rupees. 80s, he would have given an answer 8 rupees. 90s, he would have given an answer 32 rupees. In such an environment where the currency is getting devalued to such an extent that the
Hmm.
currency is losing value, that's not very favorable for our long-term debt portfolio, right? Because your the amount is maturing 21 years later, but in principle that value is worth a lot lesser because your currency devalued against major global currencies at the time. Reasonable. But
Yeah.
if we ever encounter a scenario wherein the currency actually either remains flat or it appreciates against global currencies,
Hmm.
in such a case, your PF is going to be a monster instrument, and I'll explain why. All right. So currently, like we know that till before the Russia-Ukraine war, US interest rates were near 0%, right? And which means that if you invested a dollar in the market, you would have got 0% or 1%, whatever is the minimal value of that, right? And if you invest the rupee in the market in the PPF, you end up getting, let's say, 8%. All right, which feels like 10, 11% because it is exempt from all sorts of taxes. So, when you net it, it'll feel like 10, 11%, you know. My point being that if you are in the high, so today you are not in the highest tax slab in the country,
Hmm.
but that status quo will change 20 years later. You might end up being in the highest tax slab in the country. In the event you're in the highest tax slab of the country, you're literally paying 44% as income tax. So
Hmm.
for you to have earned net 7.5, 8% interest on your investment, you would have actually had to generate a gross 12 to 13% interest on that instrument. Is that making sense?
Hmm.
Yeah.
Somewhat. Yeah.
For example, for example, you make 12%. Let's say you invest in a fund which generates 12% for you.
Hmm.
All right. 13% interest for you, or
Hmm.
CAGR. And you are to pay 40% or 45% of it as income tax,
Hmm.
right? So essentially, the 13% simply becomes 7% for you. half of
Yeah.
it is gone in tax,
Yeah.
right? But since this is tax exempt,
Hmm.
right? So you are getting the 7 to 8%, but it is
Hmm.
like saying that if you eventually in the 20-year life cycle of your investment, you actually end up reaching the highest tax slab in the country. It is
Hmm.
almost like earning 13-14% on an investment, which is at par with what mutual funds even today claim in hyper bullish market scenarios, that this is what you should expect, 12 to 14, 15%. Making sense?
In the sense you're saying that basically you're comparing it to the fact that if you were to invest in a mutual fund, you would get 14%, but you
Hmm.
would lose at least 4% of it through tax, and in the end, you end up
Yeah.
getting around 7 to 8, 12%, whatever. And here
Yeah.
you are getting that guaranteed.
Hmm.
So, and you don't have to pay tax on it. So it doesn't, so in that sense, it equates. Is that what
Yeah.
you're saying? Makes sense.
Yeah,
Yeah.
yeah, yeah. Because if even if you were to not reach the highest tax slab, say 44% tax slab,
Hmm.
even if you would reach a slab below it, even that is 33%,
Hmm.
which is most common tax slab. Like if you have any reasonably well-off upper middle class family friends,
Hmm.
yourself included, you might just see you could just be falling in the 32% tax slab,
Hmm.
right? So now, which means that a third of your earnings are taken away by the government. So
Hmm.
if the mutual fund indeed did give you 12% CAGR, a third of it is going to be taken by the government. That is 4% is going to be taken by the government, and you're going to be left with 8%.
Makes sense.
And
Yeah.
PPF is also giving you 8%,
Hmm.
right? So this is what to do when we are comparing the returns. We have to compare that at the time of booking, what is going to be our likely tax liability.
Hmm.
So it is possible that maybe your tax liability at this point is quite low, but it might not always be the case.
Hmm.
Yeah, by the time 40, 50 or something, you might have quite a lot of tax liability. So you have to factor that in your decision making. And but coming back to the initial point that I was making is that let's just say, for example, you are to invest $1.
Hmm.
All right. The US dollar today will generate 5% interest because the interest rates across the world are at record high.
Hmm.
And similarly, if you were to invest 1 rupee, the 1 rupee in the PPF would generate 8% interest. That has nothing to do with the world global interest rate scenarios. It is a decision that they take each year, or they have the potential to change that interest rate each year based on our internal inflation and everything of that sort. Right. Now, what happens is that, like, let's just say you invest 100 rupees in the PPF, and let's just say 100 rupees is equal to 1 British pound,
Hmm.
right? And let us just say you're getting your 8% tax exempt interest on that. Okay. Now, we can obviously do it on an Excel sheet. 100 rupees at 8% CAGR for 15 years is equal to what value? That's not the point,
Hmm.
right? It is almost like saying that you have invested 1 British pound today, which is getting 8% interest.
Hmm.
These, yeah, because 100 rupees is equal to, let's just say, one
One
British
British
pound.
pound. Yeah.
Yeah, but now let's just say if the rupee appreciates against the pound.
Hmm.
Right? If the rupee appreciates against the pound, that 100 rupee that you actually went and invested is not 1 pound, but it is maybe 2 pounds, maybe 1.5 pounds, maybe 5 pounds. And now that 5 pounds is getting an 8% interest rate. That is just incredible because the British pound does not command that kind of interest rate. It will get 3%, 4%, 5%, not 8%. In other words, if your currency appreciates over the long term, your debt instruments are a huge value for money, provided they give you tax cushion.
Hmm.
Yeah.
Yeah.
So therefore, when we are investing in PPF at the age of 20, 18, or when you are creating a PPF account in the future for your kids,
Hmm.
your bet is not just that it is a risk-free interest rate. Your bet is also that the potential is that the rupee might appreciate against several underlying currencies.
But having heard that, I have two questions.
Hmm.
One, where do you draw the line? In the sense, at what point does PPF become a bad investment? Have in the sense, the government says we're going to give you 8% interest rate, for example, but they can change
Hmm.
that anytime. At what
Yeah.
point do you say that this interest is not good enough to be a worthy investment? And
Hmm.
second, if we look at history, the Indian currency has always gone down.
Yeah.
So how do you so this also means that in the future there is a very less chance that it might go up. How do
Hmm.
you say that in that sense we should even think of appreciating currency value as a point to make a decision
Hmm.
to invest in PPF?
Yeah, so the first point is at what level of the PPF do we decide that the PPF is a redundant instrument? And the answer is there is no such level. PPF is a benchmark,
Hmm.
right? It is like saying that we are at 0 feet above sea level. It
Hmm.
is like saying that 90 degrees east or 90 degrees north or something.
Hmm.
It's the reference point, right? And all that we can do is allocate 1 unit. And by allocating, let's just assume you're only saving 1.5 lakh a year.
Hmm.
That's all that you save,
Hmm.
right? 25-year perspective, that is the only money that you actually do save. Then why would you put it in a risky asset class? That's the only thing you have.
Hmm.
If someone were to put that 1.5 lakh in a Bitcoin, then or in a crypto, now that person will be experiencing a significant change in his or her net worth for what?
Hmm.
Right? Because we are not using technical analysis or fundamental analysis. We are simply using a comparative base, and the base is that the most secure asset class in the world for us is offering a certain amount of interest,
Hmm.
and everything else, and this secure asset class by definition adds more value to our lives. Adjective secure means. Oh, sorry. Fixed or fastened.
Hmm.
Yeah. So the most secure asset class in the world is giving a certain interest to us, and everything else now where we are going to take risk should actually beat that.
Hmm. Makes sense. Yeah.
And the only reason why we are investing is because the cap of it is decided by the government. You can't
Hmm.
invest only more than 1.5 lakh.
Huh. Okay.
So the investment decisions should start coming into your 1.5 lakh is approximately 12,000 rupees a month. In
Hmm.
other words, the government is saying take risk provided you're saving more than 12,000 rupees a month.
Hmm. So your viewpoint is that if you are not, if you want to invest and you're not able to make your savings are not enough to even reach that 1.5 level, you should put
Yeah.
all your savings into a PPF, even if you're
Yeah,
willing to take
because
a risk.
yeah, what's the meaning of taking risk? Meaning of taking risk is to be able to create multiple income sources,
Hmm.
right? And clearly you're not. If that's all you're saving,
Hmm.
right, then clearly uh, either you're taking the multiple income sources, but you might be having a lot of liabilities in terms of expenses. Maybe there are like six dependents on you now.
Hmm. Hmm. Hmm.
But if we look at the standard condition, if you're not even saving 1.5 lakh rupee a year, then why are we even having a discussion on how to invest and grow?
Hmm.
Investment and growth is the precursor to investing is to have surplus. And the question is not that at what value does PPF become useless. The question is at what value is your investment savings high enough for you to come in the market? Why
Hmm.
should you come in the market only when there is something that is offering you 12 to 14% tax adjusted returns
Hmm.
with absolutely no risk of default? And the only risk that we are seeing is the potential of a currency devaluation, that our currency devaluates significantly enough. And there is an environment of hyperinflation in our economy, significantly high enough. Unless these two situations are coming, um, there is no risk to this at all, actually. This is a highly profitable product.
Makes sense.
Huge.
Yeah.
Yeah. So the first adjustment that I would make in your overall portfolio would be to actually put 1.5 lakh in PPF and then do the talking that, okay, I have done the PPF. Now, how much money do I have? And
Hmm.
then the second part of it comes that the historic trend of the rupee. All
Hmm.
right. So now the historic trend of the rupee, obviously it's downwards. There is no ambiguity. So you are too young to remember it. But when I was in my 20s and when we used to go to college on a bike, all
Hmm.
right, the cops used to be hiding behind the trees to literally catch us jumping a signal.
Mm.
All right. The corruption was so high in this country. If when in the 90s, when I was a child, if someone had to buy a TV or a VCR, they literally had to fly to Singapore and then bribe the guy in the customs to be able to bring it duty free. All right.
Oh,
That was the India that we are talking about in the 80s and the 90s. The corruptions was at a level you cannot imagine. And it was ingrained in the very fabric of our society. For example, in the period 1982, 1 rupee, $1 was worth 8 rupees. In the period 1992, $1 was worth 32 rupees. We lost 300% of our currency in that decade. This is not a
mm.
joke. A country which lose 300% in a decade, they barely stand together. And this, which is actually a balance of payment or balance of payment crisis, is actually taught as a liberalization plan of the Indian economy, like as if it was something, it was like an accomplishment for us in 92. Actually, it's a matter of grave shame what we experienced in 92, where the rupee was literally worthless. Like it loses 300% of its valuation in a decade. And most of it happened between 89 to 92. And it was not just that the Indian rupee failed at that time. You would see that that period coincides with East West Germany unification. It'll coincide with the all time high that the Japanese market made in 91. It'll coincide with the breaking up of the USSR around that period. It will coincide pretty close to the your Gulf War. That was a period. So there is a saying, right, in macroeconomics that there are decades when weeks happen, and there are weeks when decades happen.
Mm.
So that is to say that there are long phases in the world where almost seemingly everything seems the same. Like for example, the price of gold. It'll seem like it's not changing at all for decades.
Yeah.
But then there are these few weeks where decades happen, where all of a sudden gold would take a move which will compensate for the entire 2 3 decade of lackluster performance. And this is just an example that I was trying to give. So my point here is that yes, the rupee has lost a lot. Like it has
Mm.
lost a lot of value compared to from Bretton Woods. Bretton Woods is the time where they abolished the gold standard in 1972. So compared to that, and I would say right up till 2012, because I use each decade. So 1972 was Bretton Woods, so I see 1972, 1982, 1992, etc. as the valuation. So compared to that, there is absolutely no ambiguity that the rupee has lost absolutely a lot. But when you look at the period 2012 to 2022, all right. When you look at that period, you will actually, and if you see the rupee against the British pound, you will see the rupee has appreciated against the British pound, making it the first decade since independent history that the rupee has appreciated against the pound. And not just the pound. Against the euro, we have appreciated. Against the yen, we have appreciated. Currencies like Russian ruble, which were worth 1 ruble, was worth 17 rupees and 92. Today it is 1:1 for us. Turkish lira, we have outperformed it by hundreds of thousands of percents. Yeah. Name an African currency, we have outperformed them. Name a South Asian currency, we have outperformed them. Name any Latin American currency, we have outperformed them. In this particular decade, the only currency where which we have not outperformed is the US dollar,
Yes, dollar. Yeah.
and that has happened at the back of world record, like record high interest rates. So what happens when the interest rates increase? Let us say you're a country called Zimbabwe or Iran or some country, and your country or Pakistan, for example, and your country has $10 billion loan,
Mm.
which you took when the interest rate was 1%. So obviously, $10 billion loan taken at an interest rate of 1% will attract a certain amount of interest, right? Which you are paying from your forex. So, which let's assume that is you borrow $100 and it is at a rate of 1%. So you are paying $1 each year as the interest from your forex reserves,
Mm.
right? But all of a sudden, US interest rates become 6%. Now, for that $100 which you borrowed, you are liable to pay $6 each year from your forex reserves. So how are you going to be able to get those dollars? By selling off your own currency and buying the dollar. So
Mm.
every time the US government increases the interest rates, the pressure is spilled over on all those countries which have borrowed on the US dollar. And if you look at India's borrowings, it is negligible in the US dollar. I mean, it's not that high. But when you look at the global borrowings on US dollar, every time US increases it by say 10 basis point, some country in Africa collapses. If it increases by 100 basis point, there are government changes in, like, there will might be an Arab Spring or something somewhere. Regimes will change. That's the kind of pressure that is there. So which means we are looking at a scenario where the interest rates in the US market at the record high. And the question is, what has India done against the US in the last, say, 2012 to 2022? So from 1972 till 2012, we were losing 5% per year against the dollar.
Hmm.
All right, per year. CAGR,
Hmm.
CAGR. Yeah. Or let's just say we were average losing 50% a decade. That is certain. We were losing 50% against the dollar. So now the dollar in 2012 was valued at 68. We will always use the highs and the lows as the references. We don't have to worry about the closing on that day and closing on this day. The worst performing value of the rupee against the dollar, because that is our concern when we are investing, was 68, right? And if the rupee had to continue the same trend of slipping 50% against the dollar,
Hmm.
so that means rupee should have lost 34 rupees now, right? Half of 68 by 2022, correct? Which means by 2022, because let's say in 2012 it is 68 rupees is equal to a dollar, we lose 5% year on year, all right, which approximates to roughly 50% after a decade. So which means that we should have lost 34 rupees in 10 years. So something that is worth 68 rupees is now lost 34 rupees in value, which means today into 2022, the dollar should have been valued at 102.
Hmm.
But instead, where is the dollar? It's at 82. And where are our forex reserves? It's at 650 billion. So we are not losing value against the dollar. We are appreciating against the dollar. And I'm telling you this, once the US has to just reduce the interest rates for us to realize this, and that 8% net of tax that you are getting on the rupee is
Hmm.
almost like getting 8% on the US dollar. And I'm telling you, people in developed economies will be very happy with 8% return. So it's like getting 8% on a dollar. First of all, that's assuming rupee maintains parity with the dollar. But even if it doesn't maintain that parity with the dollar, it is very likely to maintain that parity with euro and GBP. Very, very likely. All right. Even if something goes on with the dollar for a brief period of time. So I would bet that 20 years from now, your investments in PPF, the rupee would be most probably trading higher than the dollar. And if that is to happen, it would be the first time since independence that we would be net positive against the dollar. So, point being, currency could appreciate, it could decline, but now how do we factor a depreciating currency is what we can discuss in our next call whenever we schedule that.
Hmm. Hmm.
Yeah.
Yeah. Okay. I have a lot of questions actually. Uh,
Yeah.
I have noted some of them down. And
Yeah.
we can take this up next time when we start.
Yeah, sure. We'll continue
All right.
from
Yeah.
this screen itself. All
Great.
right,
Great.
great.
All right.
Take
Yeah.
care.
Bye bye. Bye.
Bye.